For the last couple of years, getting a great return on your cash has been, well, pretty easy. But that era, it's coming to an end. The Federal Reserve just cut interest rates, and today we're going to break down exactly what that means for your money and, more importantly, where you might want to look next. All of this is based on some fantastic analysis from Barron's. Okay, so what's the first thing to get our heads around? Well, the Fed isn't panicking. You can see right here, Fed Chair Jerome Powell is calling this move an insurance policy. Think of it as a preventative step, just to make sure the job market stays strong and the economy keeps chugging along. And this is the number that really matters. The new target range for the federal funds rate is down 1/4 of a point. Now I know, that might not sound like a huge deal, but that one little change is going to send ripples through pretty much everything, from your savings account all the way to your loans.
So here's our game plan for today. First, we'll talk about what the Fed actually did. Then, the big one, what's happening to your cash yields. After that, we'll hunt for some new places to put your money, see if there's a silver lining for borrowers, and finally wrap it all up with a new financial playbook for you.
All right, let's jump into our first section. We need to be clear. This isn't just some minor adjustment. This signals a whole new reality, where the old rules for how you manage your money are really starting to shift. And listen, this is not a one-and-done kind of thing. Barron's is reporting that the markets are already pricing in 2 more cuts just like this one by the end of the year. So this is a trend, not a blip. And that means a strategy that was working for you yesterday might be totally obsolete tomorrow. Okay, so what does this new reality actually mean for the cash that's just sitting in your bank account? This right here is the heart of the issue for anyone who saves money. We're calling it the saver's squeeze. I mean, look at this. It's really a tale of before and after, isn't it? Before, it was simple. You could get these really attractive, really safe returns, maybe around 4% on your cash. Now, expect those yields to start ticking down with every single move the Fed makes. The squeeze is officially on. This quote from PIMCO's Jerome Schneider, wow, it just says it all. That warm blanket of comfort we all got used to from our safe, high-yield cash, it's disappearing. That cozy sense of security is fading, and that means it's time to start thinking about a new strategy. Which, of course, brings us to the biggest question of all. If that warm blanket is gone and cash just isn't what it used to be, where in the world do you look for returns? It is time for the hunt for yield. Let's dig in. We're going to explore the alternatives that Barron's laid out, and we'll do it step by step, starting with the safest options and then moving out to things with a little more risk, but also maybe a little more reward.
So your first move doesn't have to be some giant, risky leap. It's really just about optimizing. For example, and this is a big one, check your brokerage sweep account. You'd be surprised how many are earning next to nothing. Or you could think about something like a no-penalty CD to lock in some of today's higher rates before they drop even further.
Now, if you're willing to step out a little bit on that risk ladder, multi-sector bond funds are a really interesting idea. See, they don't just buy one type of bond, they spread their bets across all different kinds of debt to hunt for that higher income. And when you look at the returns of funds like these, you can see the strategy has been paying off. And finally, let's not forget stocks. Lower rates can actually be a pretty big tailwind for the stock market. Barron's points to a few areas that are worth watching. You've got high-yield MLPs, often in the energy space. You've got small-cap stocks, because they really benefit from cheaper borrowing costs. And then you have defensive sectors, like financials and healthcare, which can hold up well even if the economy slows down. Okay, so we've talked a lot about savers feeling the squeeze, but there is an other side to this story. For people who actually owe money, there might be a potential upside here. Let's flip the coin over and take a look. This is probably the #1 question on every homeowner's mind, right? And for anyone thinking about buying a home. But unfortunately, the answer, it's just not as simple as you might think. So here's the deal, and this is absolutely crucial. It all depends on what your loan is actually tied to. If you have a home equity line of credit, a HELOC, you're in luck. Those rates move in perfect lockstep with the Fed. But mortgages, they track the 10-year Treasury yield, which is a whole different animal. So for your mortgage, there's just no guarantee that rates will fall. All right, we have covered a ton of ground, so let's bring it all together. Let's distill everything down into a simple 4-step playbook that you can actually use to navigate this new financial environment. So here it is, your playbook. It starts with defense. Audit your cash, know what you're earning, and lock in today's rates before they fall. Then you move to offense, exploring new sources of yield in things like bonds or equities. And finally, it's about being smart with your debt, knowing exactly how these changes are going to affect you. And that really is the bottom line here. The era of easy, safe returns is shifting. It's changing right under our feet. And that leaves every single one of us with a really critical question we need to answer about our own financial strategy.